Hello and welcome to another episode of the Opportunity Podcast. I'm your host, Greg Elfring, the head of marketing over here at Empire Flippers. Today, I am speaking with a very old friend of mine, Mike Swigunski. Him and I were actually hired at the exact same time at Empire Flippers way back in the day, like over 10 years ago at this point. But Swig has gone on to go and acquire his own businesses, and now he is going to build his own fund using a business called Dividends, his business, Dividends, where they are going to have multiple different funds for investors to come and invest in with a little bit of a twist. So Sway Guy, we catch up a little bit at the beginning of this episode, and then one of his answers kind of blends into the introduction to dividends, so we skip ahead there. But overall, I think this is a fun conversation. If you are someone looking to get exposure into the digital asset world, where you do not need to be the operator and you don't need to provide some massive check, but you can still get some kind of investment back from your money in this space, like whether it's SaaS, agencies, whatever digitally native businesses that are recurring revenue, then this might be a really good podcast for you because that's exactly what Mike is doing with Dividends. So with that said, I will stop talking and we'll get into the episode. I'll see you on the other side. All right. I have Mike Swigunski with me here today, the founder of Dividends and an old friend of mine. I'm sure we'll cover a bit of our history together as heroes and villains in this industry together. But Swig, it's such a pleasure to have you on the show. I believe you've been on the show before, but it's been a while. So for anyone who doesn't know who you are, why don't you give us a brief background?
Yeah, Greg. So it's awesome to join here. Looking forward to diving into dividends and just kind of the whole acquisition thesis that we have here. But as far as my background, I joined Empire Flippers as a tie with employee number 4 alongside you.
Ooh, you were so lucky you said that because Lauren put in this questionnaire that you were employee number 4, and that is a highly debatable topic.
And I think I want to say, like, looking back, I think you actually arrived earlier because I remember you got the better room in the penthouse that we were working at. And I was like, okay, so I think he's, employee number 4A. I might be employee number 4B.
So here's some fun trivia that I don't know if you know. I was actually employee number 4B, and you were employee number 4C because the actual guy that was supposed to get the job in his second interview, he showed up wasted or something for the interview.
Oh, wow.
So thank God for that guy, dude.
Yeah, so just back to give people a time frame, we both joined Empire Flippers in 2016. And yeah, I was with the company until 2020. And during that time, I'd published my book in around 2018, started also kind of realizing, hey, we're talking about how awesome this industry is. And, we're doing a lot of marketing around the space. So I actually took it to start buying my own businesses. And in 2019, acquired my first software business, kind of had utilized a lot of the similar marketing techniques we were using at Empire Flippers and just on a much smaller scale and just kind of implemented those. And so within 8 months had gotten my investment back. And that was really like that light bulb moment, like, hey, this industry, there's a lot of opportunities to this, especially if you are a decent operator and you kind of can come into a business with a thesis on, okay, the prior owner was able to get the product market fit correct, but is really missing out on these opportunities to grow and scale the business. And so I've been essentially going through since that first acquisition in 2019, just buying slightly larger businesses, consulting in the space through first-time buyers, first-time people who are looking to buy, people who are looking to exit, and even have done some crazy consulting for people like the Rothschild family who are looking to learn a little bit more about micro acquisitions and kind of the $10 million and below range.
I didn't even know about that one. You and I talk pretty frequently. What was that all about?
So unfortunately, there's a lot of NDAs and kind of disclosures. I can't go super deep on it. But what I can say is
this is the podcast for you to break the law. And I give you my permission. I'm not the one going to get sued for it. So please go ahead.
So the Rothschild family has a division called the Three Arrows, which is kind of their investment arm. And essentially they wanted me to come on as a consultant because they were looking to kind of get into the brokering space. And essentially the consulting turned into later a job offer to kind of build a European brokerage. which ended up like declining the offer in the end just because it wasn't a fit for kind of what I wanted to do long term. So it was more or less building a, let's just say, kind of during the aggregator eras where a lot of people were going heavy on e-com. They saw opportunities in Europe and Germany to build out these types of brokerages, and they had a little bit of a fund. And so in the end, yeah, just kind of stuck at a consulting role, didn't go into kind of what they wanted me to do with build a full on brokerage for them, just because I didn't see the interest from my side. So
Yeah.
have learned a lot about the space because, again, like buying a business gives you a kind of that other side of the table. So working with a variety of other brokers, people in the space, private deals, it just gave me like a really good perspective on like what's good about the space, how the other people stack up. And in the end, I love the Empire Flippers process because the curation is such a key element that it really saves me a lot of time when I'm looking for deals. It really gives me a lot more, I guess, confidence going into that. So that's typically why I love doing deals with you guys, because you make my job a lot easier.
Yeah, man. I mean, I don't want this to be super self-promotional of EF, but I've like talked with other brokers now over the years, and I get how other people do things versus how we do it. And I would say our vetting process, hands down, is like one of the biggest, not the only one, but a big differentiator, especially on the buy side. Is annoying for the seller, right, to go through that, but from the buy side, it's so good because like I've seen some of these other brokers, like P&Ls are all messed up. There's no tax returns, just like nothing going on. It's just like they just let the seller upload anything and call it a day and put a multiple on it, right? So you can get some really fly by night brokers out here in this space, as I'm sure you are well aware of. Before we get into more of your acquisition stuff, I mean, you've been in the game about the same length as me. I mean, we got hired together, right? Our paths diverged a bit, but we're still pretty much in the same industry doing similar things. How have you seen the buying opportunity change over the last 10 years from, say, when we started back in 2016 to today?
Yeah, I mean, a lot has definitely changed, especially like the big milestones that I can think of is during COVID and during the aggregator space where like everyone was focused on FBA e-commerce. And now it's kind of like a weird market where I don't really know where it's going to end up. I kind of have my guesstimates or thesis on what's going to happen. But I think AI is going to disrupt every industry and every sort of business is going to have some impact. And that's why like my sort of thought process is let's find a business that's under optimized, and AI is another tool that we can use to grow and scale it, outsource some of the automations, outsource some of the like team functions or customer service, and in general just make it a better business. And so a lot of times the businesses that I'm looking at, they're usually founder led and usually a technical founder that doesn't have marketing and sales experience, meaning they got the product market fit great. They got those first 100, 200 customers, but they just don't really have the kind of concept to grow and scale a business to that next level. They're really good at maintaining it, really like understand the industry and the niche, but they're busy building features instead of marketing the business. And so that's where you come in, and where my sort of buy box is finding those types of businesses coming in, implementing a sales team, a marketing team, and trying to get those like really low hanging fruits where what is the like fastest, biggest impact we can make on a business to grow it. And a lot of times it's with conversion rate optimization or CRO. And so we find a business that's likely under optimized. The checkout flow is screwed up. It's really lengthy or clunky or just asking too many details. They have high traffic but low conversions, and they haven't tested a lot of prices. So we can come in with these businesses. They're already getting people into the store, but let's just say the cash register, the sales guy isn't doing a good job of converting those people in the store into actual customers. And so that process to double or triple that conversion rate is much easier, much more simple, because changing a price on a landing page is a lot easier than trying to get, two or three times more people through SEO or paid traffic or other ways into the store. So that's kind of the main step, is like, let's fix that leak. Let's optimize that leak before we expand out to these other types of traffic generation sources like SEO, paid traffic, or social media, anything like that. And so that's usually step one, is like, what are those quick fixes? And, with a dev team and kind of our process, we're able to implement those things within weeks of actually acquiring the business. And so I've seen really quick results from my personal acquisitions and businesses that I consult on. And that's sort of like the hypothesis for this kind of dividends capital raise, is how can we acquire these businesses and then turn them into a portfolio that's very easy for other people to invest in, who don't have the skill sets to run a business and they don't have the capital to buy, $500,000 or $1 million business. They can have fractional ownership of that. And so the big term, long-term vision is just to make a whole new investment class where, if you go on Empire Flippers, one of the biggest bottlenecks is people either they don't have enough capital or they don't have the skill sets and time to operate the business. There's a 5 to 10% range that fit into that of qualified buyers. But again, you go to 100 people in the US and they want to actually get more cash flow or expand into alternative investments that actually pay dividends. There's not a lot of good options out there that actually do something that move the needle. So we're trying to create another whole nother asset class for people that want to get exposure to this industry. But I see it as more of like a halfway step to kind of learn about the industry before maybe they buy and run their own business on their own. So that's more or less what we're building. And yeah, happy to expand a little bit more in any way or
Yeah.
direction you see.
This answer evolved into a brief synopsis of what your next project is. So I guess we should skip to that a bit to give the audience some background on dividends. Why don't you describe? I mean, you kind of did there at the tail end, but to give me a high level overview of what you're doing for dividends so the audience understands.
Yeah, so the simplest way to explain dividends is it's an AI investment platform. So AI powered investing, and the underlying asset is online businesses that have been fully acquired. So investors can go on the platform within a few clicks. They can get exposure to the cash flow of these businesses. Essentially, it's like going into and buying the S&P, but you have the option to buy a portfolio or an individual business, and you'll see the analytics like similar to going to Empire Flippers. But let's say you wanted to invest 3 grand or 10 grand into one of those businesses. And so the easiest example is you have a business valued at $1 million on Empire Flippers, and you get a fractional ownership of 10 people who invest 100,000 into that. So they would each get 10% of that cash flow. And so that's more or less the simple example of what we're building, is trying to basically get these sort of businesses into a portfolio that everyday passive investors can get exposure to. Does that sound clear enough, or do you want me to expand more?
No, yeah. To recap, is basically you're raising a fund that people are going to get cash flow dividends, and you're using that fund to acquire the businesses that will give them the cash flow. You're paying out like distributions on a quarterly basis, something like that to the investors.
Yeah, so the long term vision is basically just to have a whole software platform where people can go there. And so it's a little bit different than a fund, where usually a fund, you just invest money and the person behind the scenes kind of does everything. You don't have any option on like what the business is, what sort of, you know, industry or parallel it's in. And so the idea here is, you'd have a platform where maybe there's 100 different types of businesses that have more analytics on them. AI tools will give you analysis on what sort of portfolio is going to be the best fit for you. And so that investor can go say, hey, I really like the finance space. I want to invest in this portfolio. Here's the returns for the past few years. Here's how long I want to have my money kept up in this portfolio. And then here's the estimated return. So typically it'll be, we're buying these businesses, grow them, and then repackage them into a portfolio, where a lot of funds, they're collecting the money up front, then buying the business, and the investor kind of has no real input into that. So a little bit different. We're trying to build, something that's a little bit more proprietary in like the actual platform, and then underneath the underlying assets will be cash flowing businesses.
Interesting. So you're saying And maybe I don't understand this, that I know from our talks. So you're saying on dividends, you would have multiple different types of portfolios of businesses, and people can invest in them, but you're not using that money to acquire the businesses. Rather, it's kind of like you're selling, I don't know, like partial equity or phantom
Yeah.
equity to these people so they can collect on the cash flow that already is existing from something you've already acquired.
Exactly. So let's say, for example, we buy $1 million business, we grow it to 2 million. We would fractionalize a percentage of that and likely keep it a minority percentage that people can invest in. And so that way we basically get to share in that cash flow, and we also get to take some chips off the table without selling the full business. That's the initial thing. I think we'll likely in the future have kind of like, it's a chicken and egg problem here. You either need the fund
Yeah.
first or the business. So starting off, we're going to do the first round with buying businesses that investors have, given us, and then in the future we'll package those into portfolios. And so we'll likely have multiple options where somebody can just go in and get, all the portfolios, a broad sort of like exposure to every business, right? Then there's going to be options where individualized, where we haven't bought something, but we have kind of a buy box, or there'll be something that we've already acquired and people will be able to see the performance and invest in that. So I see it as kind of like, starting off, we'll have to have the proof of concept, have the businesses or business already acquired, package that into the first portfolio. And then when we expand, figuring out which direction is going to see the most appealing and be most favorable for investors.
So it's kind of like first part is more of a traditional fund in the sense you're raising the money to acquire businesses, but the big picture, it's almost like a private stock market in a sense of buying equities into these businesses. Obviously, differences because like you're buying into the equity at where the business is for this cash flow already, which is similar to how you would do it with a public stock, right? The difference is just this is just private businesses you're buying the equity into. And so the idea is there could be two different types of investors, or maybe they do a little bit of both, or whichever one they want. I'm assuming the people who are part of the acquisition money gets a higher return just because you're planning on growing
Yeah.
the business, right? But higher risk as well because you don't know if it's going to work or not on those ones.
Yeah, so there'll be like a lot of different like risk profiles on people who want, the broad exposure will likely be the safest with the lowest returns. There'll also be, shorter term investors if they just want to stake or have the money held for a year or two, that'll likely have lower returns. But the people who are kind of like, hey, I want an individual company, I want to, have the money as long as needed or 5 years holding period, those will likely have the highest returns. At least that's what our initial sort of process is going to look like.
So when someone, let's say we fast forward like, I don't know, 3, 4 years from now, everything's set up, things are groovy. You're starting to sell, the stock version of this where the business is already in your portfolio. What's the benefit of that for you? Like, I'm assuming you or your operators are still running the business, right? So I'm assuming it's something like you can use the money to grow faster or something like that. Is that kind of the plan, or is the plan with dividends to collect some kind of management fee on top of everything?
Yeah, so I think, starting off, we're figuring out how the like actual payment structure is going to be processed for management fees or like assets under management. But there'll likely be, like, let's just say, three ways that we monetize everything. The first way is just going to be from the acquisitions, right? We'll be taking a portion after we pay out investors. Our first goal is always to pay out investors first. Once we've hit our targets with them, then we'll keep a portion of those profits for operating the business, of course, but also paying out our team and it's our sort of like, operations to run and manage everything. And then again, the second way is going to be, let's just say, pro tools on the platform. So accessing reporting, analytics, other sort of things to, maybe have community meetups and stuff like that. And then the third way will just be a management fee of like the whole portfolio. So those are kind of the three ways we see to monetize the entire sort of concept of dividends.
I like the concept. I think it is quite unique selling like the equity after the acquisition and after the growth is done. I don't think I've ever heard people doing that necessarily, at least not in this way. So that's pretty a unique spin on it. What inspired you to do this? Like, why do this instead of just raise money privately and go and acquire your own stuff and not deal with these, multiple tons of investors?
Yeah, so good question. Again, there's a lot of reasons why I chose to do it this way. I've been approached to run and manage funds. It just doesn't really excite me as much. And again, maybe, you know, I'm not seeing the excitement, but I want to have a certain area where people can get entry points to this at a much lower basis, right? So most of the funds, you know, that are out there, there's either like a 50K minimum or a 100K
Yeah,
minimum. And I've talked to just thousands of people who want exposure to this and they've got 5 grand or 25 grand. It's not their life savings, but it's that percentage that they've compartmentalized a percentage of their investing pool to put into alternative assets. And usually it's anywhere from like 10 to 50 grand. And so
sure.
they want access to this. But the main problem with all of this and all these investors and all these people I've talked to in the United States and around the world is things are expensive, right? They don't need a 5 year sort of fund or more stock appreciation. They need monthly or quarterly cash distributions. And so that's the problem we're trying to solve is hey, there's a lot of options out there for you just invest in this and then in 20 years, you have that appreciation, right? This is something where we want to have a monthly cash flow and monthly income is kind of the goal. And if we can increase that for 10 to 15% for, a retail investor, that's a huge amount for them to keep up with the high rising cost of living that's happening in North America and kind of all across the world. So the reason we're doing this and the reason I'm really impassioned about this, I want to help people generate additional monthly cash flow is kind of the goal. And so it came out of need after talking to all these different investors who want exposure to this, but they either don't have enough capital to buy their own business or they don't have the time and experience to really do it. Because the person with, let's just say $1 million likely has some of the experience to do this, but sometimes they just don't have the time to do it, right? They don't want
Yeah.
to spend 10
Or the
hours.
appetite for the risk, right? Because like a lot of
Yeah.
people, I mean, a person with 50,000, $100,000 can go buy a multiple $1 million business in America using an SBA loan, right? But
Yeah.
that comes with a lot of risk with personal guarantees and a lot of unknowns. And you most likely are not doing that as a side hustle while still working at your corporate gig. You're like all in, right? Which can be quite scary for a lot of people.
Yeah. So I think, again, there's a big need for this. I've invested in just about everything, like from crypto stocks and, online businesses have consistently paid the best dividends, pun intended, and the best return.
I see what you did there. Very good.
And so, like, again, I've been a crypto investor, stock investor. And again, it looks great on paper. You have some pretty good returns, but you have to time when you buy it, you have to time when you sell it. And then you get royally screwed with all the capital gains when you do sell it.
You just reminded me of a video. I did this video, I think it was like 3, 4 years ago. It might have been longer now, actually. It was the title was something like the investment better than Bitcoin. I made all of our crypto friends so mad at me because the clickbait answer to the better investment than Bitcoin was buying a business because you have so much more control over it, right? Like you have no control over what the price of Bitcoin is going to do or a stock or like
Yeah.
real estate, you got a little bit of control, but not much. But buying a business, like you're the master of your own destiny. Obviously, there's caveats, like our poor affiliate friends in the SEO game that got hit by a bad one. But in general, when you're an entrepreneur, you just control so much more of the investment. So I think this type of stuff, like what you're saying, I think all of this is great. I do have some questions on like how you think you will be different from past people that have done like similar incarnations. So one of the companies I'm thinking of, and this is no shade to them, I love them to death. They're our sister companies, so to speak, but Web Street, which I'm sure
Yeah.
you're familiar with Web Street. They didn't have the exact same model as what you're doing, but pretty similar, right? Like a lot of portfolio, different funds that you invest in, of different types of businesses, mostly e-commerce and affiliate. And they
Yeah.
did get started kind of like the hotness of the market at the time, which is a bad time to be the buyer, right? Because your returns are going to be lower. But
Buying at the top.
they've really struggled with continuing to see growth at a scale where it made sense to do that kind of model. So what do you think like happened there and how do you think dividends is going to be different?
Yeah, I've talked pretty in depth with Mike V and Dom from Onfolio, and I've looked at, I don't know, spent countless hours researching a lot of similar sort of options out there. Fundrise is probably the biggest one we're trying to model ourselves out of, is like their whole thesis is backed on real estate and kind of like a real estate investment trust where it gives people a little bit better entry points and extra points to invest in real estate that actually cash flows. And so the biggest differentiator I would say is we're trying to one, build something proprietary, where Onfolio again is more of a stock and it's all, you don't really get to decide the businesses that you're investing in, the parallels, the industries, the niches. And then from Web Street, their sort of thesis has been a little bit different than ours. We're focused on recurring revenue businesses where we can make a big impact. And again, where the investors can eventually, on our platform, we want to have some incentive for investors to actually help move the needle on the business so they can get additional growth opportunities to essentially become an affiliate for the businesses that they're invested in. And so imagine you have 2,000 small investors in your business that are very incentivized to help grow, share the business, and also like become an affiliate for that business. So it's another sort of growth lever that we'll be utilizing to kind of, once we've implemented everything, we'll unload it to investors and say, hey guys, you can also monetize this and get some additional income on top of your investment if you become an affiliate or partner for this business. And so building a whole platform where one, people can have a lower entry point. Our goal is to have at least $100 minimum. You know, that's kind of like a much differentiator than Web Street, I think, is 60,000 as the entry
Yeah.
point.
They started off, I think, at 15, but they still like raised it steadily because it was just easier in terms of like getting the fund done, you know?
So the long-term goal is, again, we're likely going to have starting off a little bit higher minimum. Instead of going up, we'll likely go down is kind of the plan, and opening it up to, you know, much wider sort of market of people that have, you know, $100 or even $10,000 to invest or anywhere in between. And so that's the main differentiators. We want to have a proprietary system and like platform where people can go on and actually see these businesses, understand a little bit more about the growth tactics, and also utilizing a wide audience who want to actually take part in it to help grow and scale the businesses. And so that's kind of the differentiator. I would say the other big differentiator is we're focusing on a very specific part in the market. And this is where sort of my buy box has been really well for my personal acquisitions and for people I consult with, which is focusing on recurring revenue businesses that have something more of a moat around it and they have more control over their destiny. There's usually not a lot of platform risk on these types of businesses where you're dealing with the Amazon FBA, the Amazon affiliate, where you basically are kind of at their sort of, you know, control. You really like don't have a lot of say in if they change their affiliate rates or if they charge extra storage fees. You know, there's all these other sort of like things you can't really control. And that's why I love software businesses and recurring revenue businesses, because one, just the makeup of the business, you own the customer data, you actually own like the software and the product that you're selling or giving access to, and you essentially can control more of your destiny. So if something changes or you need to pivot, it's a lot faster. And so you're basically buying that head start of the customers, the moat around the business to build that sort of software and that product market fit, that it's already working, it's already functional, and you have that foundation. And it's so much easier to grow once you already have that. And so that's more or less our sort of buy box. And also, you know, running and growing Empire Flippers, I think we kind of had that bootstrap mindset, which allows us that every dollar that we get as an investor to go a little bit further. And so we've kind of really figured out like how can we make the most of a buck to actually go grow these businesses. So I think coming in with that mindset on like what are these big home run opportunities that we can look at when we're performing due diligence on these businesses, what are these home runs that we can make? And basically every business we've gone into, we've had a lot of fast success because we're able to isolate these sort of approaches to buy, scale, and just really grow these businesses in a fast, cost-effective manner.
Yeah, I mean, all that makes sense, man. I think I think that was probably one of the issues with Web Street too. And like they're still kicking along. I think they just did a pretty big acquisition. It's not like they're out of the game, but I do think the platform risk was a big mistake on their end. Like with the affiliate and FBA, like we still sell a ton of Amazon FBA, but I always tell entrepreneurs like you should look at Amazon FBA as a marketing channel, not the business, right? Because like
Yeah.
it's great from a marketing channel perspective, but you should really de-risk by having your own Shopify store, Facebook ads going to that, like the whole 9 yards, right? Like figure that out because it just creates such a better business. And I agree with you. I think software recurring businesses, like you are more the master of your own destiny. And it's something I've been talking about a lot on this podcast actually lately, which is what I call full funnel businesses, where you have full control versus like being the
Yeah.
slave to Google or Amazon or what have you. Now you mentioned software with dividends. Are you mostly looking at SaaS businesses or are you looking at anything that's recurring?
I would say like broad market recurring revenue, but mostly, let's just say 70% will be software, would be the main focus starting off early on, just because that's the majority of recurring revenue businesses that I think have a larger moat, mostly in the B2B space in niches that I don't see being too disrupted by AI, and where there is like a little bit more of a barrier to entry on these businesses where, it's not just some simple tool or sort of like plug-in that somebody could on a weekend project replicate. So again, what are these like bigger moats? Again, some of these past acquisitions, they had contracts and agreements with universities, and these universities have thousands and thousands of students who are on it. It would be very hard for somebody to come in and replicate that business because there's already such a big moat about who is actually using the software and the agreements that they have. So, what are those like businesses that you can kind of look at and say, hey, if AI, if the whiz from college was going to enter this space and whip up something using Claude Code, what is our moat? And so, again, we're looking at it from that aspect, but we're also looking at it like, hey, this founder isn't really utilizing any sort of AI to improve the product, improve the customer service, or convert, leads into customers. How can we also utilize AI to, again, make that dollar go a lot further and have a bigger impact? So we're looking at it from all angles. And again, I think to be ahead of the AI risk, you have to live and breathe the AI space. So from our developers using AI to our team and every sort of like area that we're implementing, we're trying to integrate AI as best as possible.
That makes total sense. But in terms of the moats that are not going to be, well, I shouldn't say not, but less impacted by AI, where do you think those exist? Like you mentioned things that are hard to copy in a weekend. Like what does that look like in practice?
So I think the big moats for the software is just the recurring revenue in itself, right? So you already have the customer base. They're already like every month being charged. You already have a customer that is, you're not starting at zero every month like every other business. So I think that's the moat where, again, that's a little bit of protection from somebody starting from scratch with AI. I think the B2B niches were, they're just a little bit like more boring, where like I see a lot of people who are creating AI tools and getting into the space. It seems to be more focused on B2C sort of projects, not always, but in general, where, you know, again, to work with the university's sort of like interface, it took years and years for them to get those contracts. Where even if somebody were to create a better tool, it'd be really hard for them to penetrate that market. And a lot of times they just don't know about that market because it's so niche that an individual person wouldn't really be interested in that unless they were experiencing some similar problems. So that's where I see it as kind of like finding a sweet spot in the product and sort of structure of the business itself. And then what is the moat to actually do that? A lot of these businesses, even with AI, it's still going to cost hundreds of thousands of dollars to build this because the original founder or something spent 10 to 15 years building it and continuously building it over that period of time as a passion project. Now trying to do that same thing, you might be able to do it in 2 to 3 years time, but we already have that 10, 15 year head start.
Yeah, that makes sense. I would say I saw this post from Tim Solo, which I think you know him as
Yeah,
well.
from Ahrefs.
He was talking about, I think it was something like, with clay.com, like AI can just rebuild Clay. I rebuilt my own version of Clay. Why is Clay getting this $1 billion valuation? And I was thinking, I think I commented back like, well, one, they got that before AI in a lot of ways, but two, like it's just convenient, like that's their moat. Like their UI is convenience because like Tim, you are like a crazy Ukrainian programmer. This is easy sauce for you to do, sure.
Yeah.
For like the stressed out director of marketing over here trying to sling some businesses, like I'm not a technical guy. Give me the convenience, dude. I'm happy to pay an extra like $200 a month or whatever, right? So I think that's going to become more and more of a play with SaaS. Though I do think AI is coming to eat SaaS's lunch, but to your point, having those kind of like tough to get contracts does make sense
Yeah.
as another portion. And kind of the theme of what you've been saying throughout this entire podcast, and you and I both know this, is most people suck at marketing. Like
Yeah.
you and I, like I don't think either of us would call each other a master marketer, but we're certainly better than most.
Better than average. Yeah.
But I remember, I think you'll laugh at this. I remember talking to an SEO agency owner of all things. You think that they would know marketing, but as you know, SEO and marketing sometimes are allergic to each other. But he was going on about how I can't go to these SEO conferences anymore because I'm not getting any clients. And I looked at him like, why would you get any SEO clients at an SEO conference
Yeah.
filled with SEO agencies? Like, who do you want as a client? He's like, well, I want these like, vegan food manufacturers as my clients. Like, why are you going to a vegan food like
Yeah.
conference? It's just his eyes open, like, I never thought about that. And he started going and I followed up with him. He's like, I'm crushing it. Like, yeah, like why would you think that they're at this SEO conference? But anyways, a lot of people have such funny ideas with marketing that really fall apart when you ask them like just a couple questions deeper about what they're trying to do. Like taking these businesses and doing that marketing is obviously an easy win. So I do have another question here for you. Another issue Web3 had is finding good operators for these, like for the multiple funds that they have,
Yeah.
right? So I mean, like part of that, I think their problem is they were trying to go too big too fast. So it was hard to keep a portfolio of build the relationships with these operators. For your setup, how are you going to do that? Are you going to bring in operators as well? Is it going to be more of a kind of a slow rollout with your own internal team doing that? Like, what's your thoughts there?
Yeah, so I think like long term, we'll have an individual operator focus on each business and they'll be highly incentivized for the performance where it won't just be, like an average person just doing everything. But starting off, we'll have an internal team that kind of manages multiple businesses and I'll be overseeing each one. That's kind of like stage one. Stage two will be onboarding individual operators for each business. And a big portion of their payment structure will be on the monthly or quarterly performance of that business. So they'll be allocated to that growth. And so, again, I think the operator space is a tricky one because the best operators, they're likely doing it themselves or they're, like the disjointed like amount where the math just doesn't make sense. So a lot of times you got to go offshore. And so being a remote business has kind of showed me like, hey, you can find some really good operators. Maybe they're really well versed in certain areas to grow and scale these businesses. So I think starting off, we'll be utilizing in-house teams that are good at certain areas like PPC, SEO. They'll have their specific area of expertise. And then big term, as we're doing larger and larger deals, we'll have individual operators for each business. But again, yeah, just have to find the right person and the right talent and quickly incentivize them if they're not getting results and they're not really performing well. I think you have to like fire them and kind of move on to a new operator, which is a very challenging sort of thing that we're looking forward to overcoming.
So no equity to the operators. You're looking to incentivize them just purely through profit share of some sort.
Yeah. Exactly.
Okay.
So I think we'll have a long-term equity in like all dividends for, employees where it'll be kind of this similar sort of Silicon Valley investment vesting schedule where, they have a certain amount of shares over a 4-year period. They get a percentage of those shares. So they'll still have access to those, but each sort of business that they're in charge of, they'll share in the profit.
How big would you say the businesses you're looking at to target, and how many of them would be in a portfolio?
Yeah, so again, it really depends on how much capital we raise on this first round, but likely the goal is $2 million on this first round, which would be between 2 to 3 businesses. The sweet spot that I found where there's a lot of leverage for the buyers is between that 400 to 800,000 range. And the reason that this area has been really good for me and, my sort of prior acquisitions is one, there's not a lot of competition for other buyers at that range. It's usually too big for the individual buyers and it's too small for the portfolio buyers where talking to a lot of these people who are running funds, once you get above that, $5 million range, the really good businesses are super competitive and the terms are not great for the buyer. Where in this range, we're able to really dictate some really good terms and negotiate some crazy good multiples. And so again, it's being able to give us that a really like strong leg up when we go into a deal. We can kind of not set our terms, but we can get really good terms that are win-win for ourselves and what the seller is looking for. So that sort of range has been kind of the sweet spot we're looking to acquire deals in.
That makes total sense. I've often said on this podcast and on other podcasts that the kind of like the orphan zone of selling a business is between that 500,000 to $1 million range.
Yeah.
400,000, I'd like go down a little bit, I guess. I'd agree at that range too. And it's for the exact reasons you just mentioned. It's tough to get buyers in that phase because it's just slightly too big or slightly too small. But from a buyer perspective, it's a fantastic area for those exact same reasons, just like way less competition. I think the biggest seller finance deal I've ever seen happen in that range, which is like 50% of the value of the business, which is awesome. Not
Yeah.
awesome for us as the broker, but nor the seller, but definitely awesome for the buyer. Of course, most of them aren't that aggressive, but you can really do some pretty interesting deals when it comes to that. So I guess we'll kind of wrap up this podcast or lead towards the end here talking about how you're like deal structuring this. Obviously, you're raising money from investors. Are you using any other kind of like debt stack or equity injections or anything like that? Is your preferred deal structure with these?
Yeah, so you can follow the raise and see all the terms on wefunder.com/dividends, but we're doing a pretty unique raise. Most people just raise in a safe, which is essentially just equity. So we're doing the long-term equity in this raise, but we're also giving rev share on the business and like the revenue that the business that we acquire generates. And so it's kind of a unique thing where people get the long-term equity of all dividends and our plan is to have, billions of dollars in assets under management, but you're also going to get the short-term quarterly payouts on this round. And so we're not taking advantage of anything else outside of that, but we will go into it and say, hey, we have this much capital, we have this experience, we are a very serious buyer. And when you come to the table with that and you have a track record, you know who to talk to. And again, working with Empire Flippers and other brokers, I've done a lot of deals with all these people. They understand and they kind of, I wouldn't say they push people to work with us, but they essentially can give them a confident background that, hey, this individual has done multiple deals. He is a serious, when he makes an offer, it is a serious offer. And so we've out competed, multiple different other buyers in some more competitive deals that we've done because of that. And because we really want to take this business and give it a new home and kind of bring it to that next level. And I think a lot of sellers also want that for their business. They want their business to go on and flourish and have an operator that's super passionate about it and kind of take it to that next level. So yeah, that's basically the status. Is we've had some really good milestones as far as the raise so far. We made it to the quarterfinals as the most fundable company for Pepperdine University. So if we win that
Right on.
contest, it'll be $1 million sort of, I guess, investment
Is
opportunity.
that like a
And
grant or how did you get involved with Pepperdine?
it's just a like competition that they hold every year. So we made it to the quarterfinals. It'll likely be a few more weeks to figure out if we make it to the next stage. But it's kind of like March Madness with all the basketball teams where
Interesting.
they have people
You don't have to be
reviewing.
going to Pepperdine to qualify for it. Anyone can do it.
No, it's just a competition that they host and have some funding for startups.
It's pretty cool. Well, hopefully you win and get that $1 million, and then we could transfer that wealth into Empire Flippers, which is always the best way to run a fund, of course. But this sounds cool, dude. So it sounds like it's a pretty simple finance stack you're using, which is just I shouldn't say simple, but using just the investor money and then whatever seller finance or earn out you can negotiate with the seller more or less.
Yeah. So with the seller and the deal, again, we're always trying to get the best terms, for the deal. So it'd be a combination of seller financing, most likely.
Yeah, I mean that is always the go-to. I was talking to this guy, man. One of those stories that like you've dealt with sellers a lot, both as a broker with us and doing what you're doing. But I was talking to a buddy of mine. He has like a probably $3.5 million agency, and I was telling him like, yeah, probably get like 20-30% seller finance on it, like some mixture of seller finance to earn out when you come to sell it with us. And he's like, that's crazy. I'm like, what do you mean? That's crazy. It's like very normal. He's like, no,
Yeah.
no, it's not. Like, no, it definitely is, dude. And the funny thing about it that made me laugh so much with this guy is he's selling the agency because he's like really excited about getting into M&A stuff himself. And so he's creating this like exit planning software. I was like, dude, you are going to be in such a rude awakening and you're going to have all of your clients so pissed at you if you tell them they're going to get 100% upfront for their deals. That like never happens, dude. Very rarely that it happens, especially in our area. Like more offline stuff like HVAC, of course, they're like the darling of the ball. But even like really good businesses that are not in our space, they still tend to get like 10-15% seller finance. Is very normal. But anyways, what's your go-to market plan with this? So let's say you raise the money, how are you going to go find these businesses to acquire?
Yeah, so it'd be right now just focusing on the actual raise because we really need to see like where we end up as far as the amount. Because again, if we raise 2 million, it's going to be a little bit different if we raise 1 million, right? The good thing is we are always looking at deals every day. I'm checking out Empire Flippers, and I have also some private deal flow for people that I've consulted with who've bought businesses, over the past 2 to 3 years. Some of them are like, hey, I've held this, it's cash flowed, I'm ready to exit. So there is a combination of like private deal flow that I also have access to as well, which is pretty cool to have that even on a smaller sort of caliber. It is good to have people constantly, looking to sell their business and also attending a lot of conferences, talking to people in private networks. At some point in stage, people are like, hey, I do want to sell this business. Would it be a good fit for dividends? But likely, first off, we'll just be looking at deals with brokers, marketplaces to see what's a good fit.
Yeah, that's what I would recommend too for anyone that raises money. You see all this talk like, oh, it needs to always be off market deals to the point where it's gotten almost comical. There's
Yeah.
this person on LinkedIn. She's built an amazing like media brand. I think it's SMB Deal Hunter or whatever. They're always talking about these off market deals, get access to the off market deals. Like, well, if they get access to it, it's not really off market anymore.
Yeah.
It's on market. It's on your market. I think going with brokers is always the way to do it. Like shop around, all that kind of stuff. Like, I talk to anyone out there listening who listens to these gurus saying don't use a broker. I can tell you, and Swig, I'm sure you'd agree, like people who are like big in this space in their CRM, they'll have the marketing attribution, like where did this deal come from, like SEO, PPC, and then broker, right? And all the brokers are in that one marketing channel in the CRM. So I think that makes total sense. I do have a final question here on the fun, and then we'll move into a rapid fire section here. A big part of investing into a business or building a business is the exit at the end of the day, even if you're acquiring it, right? So with these businesses, are you looking to long-term hold? Or are you going to build up to a certain amount of value to sell them? Like maybe you open up for the equity holders first and then you sell it or something like that. And in the event of a sell, what do the investors get out of that?
Yeah. So the target right now is a 2 to 3 year period, depending on, how the performance of the business is and sort of what the entry multiple is and what our anticipated exit multiple is. So I would say around 2 to 3 year target. Some will be longer, around 4 to 5 years. But again, that's how a lot of investors are going to get that money back, right? So they'll be getting the quarterly distribution starting off, and then our sort of target for the year is up to 15% cash yield, and then a lot of that will come back on the exit once we've sold the businesses. As far as like what the terms are and the payback for investors, so our first, like, we have VIP terms on WeFunder, and so basically the first $250,000 invested, they get a 1.75 payback. So if you invest $10,000, our payback terms would be 1750. After that first 250, it drops down to 1.5. So if you come in later in the round, you invest that $10,000, you'd be getting $15,000 paid back. And so that's the rev share aspect. You would
1,500.
still,
Yeah.
sorry,
You said 15,000 on the $10,000, or did you mean 1,500?
15,000. So you'd be
Okay.
getting your initial $10,000 investment back plus an additional
Gotcha.
$5,000.
Gotcha. And what kind of schedule is that? The 1.5 and 1.7? Is that like payback period, like within a year, like you get like some kind of preferential treatment, or?
No, so there's no set schedule on it because again, a big portion of that payback will likely come on the exit. So it's our sort of anticipation is let's just say 2 to 3 year period. But the cool thing about this initial round is you're getting that payback of the 1.75 or the 1.5, but even after that's been met, you still get the long-term equity in dividends. And so we're doing a safe, which is basically an equity raise. And then on the next round, when we start raising money in the future, you get a 20% discount at whatever valuation we raise at. So it's kind of like the best of both worlds for investors.
Interesting. Well, I think it's a cool idea, dude. It's something I've seen people do with often. I think they've made mistakes that could have been avoided, but hindsight's always 2020. I think you're avoiding some of those mistakes. So I think that's cool. But with that said, it's time for the lightning round. So I'm going to ask you some three quick questions and I want three quick answers. Are you ready, my
Yeah.
friend? All right, let me pull these up. And it's good job answering the first question. We're down to two. So, all right, first rapid fire question, Matt. What do you think is the best hidden growth opportunity in acquisitions today?
Good question. Hidden growth, I think AI is the easy answer. And I think people just aren't utilizing it the right way. So I'd say, like, for the short, sweet answer, ChatGPT and Claude are like the hidden growth tools to use. It's just not everyone's using it in the right way. So I look at it like, how can we improve the customer experience and how can we get people who are in our store to a better outcome quicker and to buy more? And so whether that's with AI tools, calling leads faster, getting them booked on calls, sending more dedicated and custom emails or text messages, just kind of customizing like that experience where maybe you needed a team of 100 people to really give them that white glove treatment of, hey, you're in the store, let me introduce you as soon as you come there and be your personal assistant through the shopping experience. You can now do that with AI. So that's I guess the short answer.
I agree. I mean, AI is everywhere, and I do think most people are not using it very well. So much AI slop on LinkedIn and Facebook. Like all my friends are
Yeah.
ChatGPT API wrappers now. So I think that's like the wrong use of AI, but there's so many good uses. So I do agree with you there. For someone who wants to get in the game of acquisitions, whether it's full-time operator or like maybe investing with dividends, what would you say are some good tools or resources someone could use to learn more about the game?
I mean, I think YouTube's a great one, then just kind of like consuming content on yourself. But again, I think like whatever sort of industry or parallel you want to get in with acquisitions, I think you also need to like do it yourself. So, like for example, if you're wanting to get into the e-com space, like building a Shopify store yourself, trying to sell some product, you don't have to like build a full on like massive $100,000 store, but just start at a small scale. Like, what's the smallest sort of entry point you can do to get that experience? So I'd say like try it yourself at a smaller scale, learn about the parallel of building, get your hands actually dirty, then learn about content on YouTube, podcasts, reach out to experts that have one, done it for themselves, but two, have helped other people in a similar situation achieve the results that you want to achieve. That's kind of the second sort of step. Talk to those people, see if they have mentorship, coaching opportunities. And that's the only real shortcut in this space, is to learn from actual experts who are doing it and see if there's a way to incentivize them to help you kind of reduce that learning curve before you kind of go full on to do it yourself. So that would be kind of the short answer there.
Yeah, it makes sense. And I agree with that too, to a certain extent. Like, people think about buying a business and they always think like this $4 or $5 million thing, but like you can go buy $1,000 business. It probably won't be like the best acquisition in the world, but like there's still opportunities of things to learn. Like you learn what an asset purchase agreement is, you learn how to transfer something. Like these are skills that build up into the bigger and bigger dollar amounts, right? So it's not like buying the $1,000 thing is the thing. It's just like part of the process and getting comfortable with it. And so much of would-be acquirers, I think, are stumped by fear, fear of the unknown. What am I losing all my money? Like, if you put $1,000 and yeah, you might lose it, but it's $1,000 at the end of the day. You probably learn something out of it, right? So I agree with you there. All right, final question, hardest question. In your last 10 years of being in the digital M&A world, like with me, what has been your funniest moment working in it?
I think it was probably our donkey ride in
I
in
knew
uh,
you were going to
in the
say
Philippines, where I
that.
don't know if it was M&A related, but we had spent a few months in the Philippines, or a month there with hot money magnati in Manila, and we basically planned to hike this volcano. And Greg took the smart kind of route of taking a donkey up the hill, and I took the stupid route of walking. And so again, it's probably an analogy there that there's two ways to climb the volcano in the Philippines. One is probably a little bit easier and more exciting on a donkey, and the other one is a little bit harder when
Dude,
you're.
I felt like I was breaking that donkey's back. It was like this poor starved donkey. And I was fatter back then too, just coming from Alaska. I had all my blubber still on me. This donkey looked like it could not support me, man. That was a fun trip though. I had a blast. I'm glad I did ride the donkey because I think it was too fat for that mountain if I didn't ride the
It
donkey.
was hot out. So, no, there's definitely been a lot of good memories. I'd say all the in-person stuff, I think, like, I love being able to work remote and have remote teams, but I do think there's a time and a place for the in-person stuff. It doesn't need to be every day. It doesn't need to be every week. But I think, like, those sort of in-person events with your teammates or friends or anything like that is always kind of the highlights when you get the right people in the right rooms and kind of have like a laid back environment. Some really good ideas can happen. And I would say, like, me, you, and Justin kind of just like masterminding in some 5-star hotel. Like, it's very hard to replicate that on Zoom. And I think there is something to that, kind of like art sort of like mindset where you don't really have some sort of distraction going on. You don't have another call coming up. You're just like, hey, block out everything. We're just going to sit in a room for like 4 to 8 hours. And some really great ideas came out. I think it's where the Empire Retreat was born.
It was the Crown Club, one of your fan favorite that's still kind of not done, but sort of might happen. A lot of good ideas coming out of that, though. And like, there's something about the serendipity of just like being in person. I'm not arguing against remote work because you and I are both full in on
Yeah.
remote work. Because like most offices, they're not meeting in a 5-star hotel, right?
Yeah.
So if you're a remote team, like you could do that every now and then, right? Like it's not like you have this super long real estate lease or something. So I agree with all of that. And the donkey ride is one of my favorite memories. And I'm glad that you send me a picture of me on the donkey almost once a year to
Yeah.
remind
Facebook always
me of that
reminds
poor
me.
donkey.
The best part was is like they gave us a printed, like a physical photo, and it was in a frame. And like, I don't know what happened to it, but
I still have it somewhere. It's somewhere in my apartment, I believe. Me heroically riding that donkey, dude, with a hat. And back then, I was still so new to Asia. I was still wearing like light color, like pastel shirts, so you just see the sweat like
the sweat.
everywhere. It was terrible. I also weighed like probably 50 pounds heavier than I am today. So
Yeah, man, you're looking good.
thanks, buddy. Thanks. Still sweat a lot, but not nearly as bad as I used to. I'm like caught between too hot in Vietnam and now too cold when I go back to Alaska. So I'm the best of both worlds now. But thanks for coming on, dude. It's always such a pleasure to speak with you. I really hope this goes well for you. I always love supporting you if I can in the space. So for anyone that wants to pick your brain, learn more about dividends, or maybe just want to connect with you personally, where should we send them?
Yeah, so Mike Swigunski on all social media, pretty active on LinkedIn, Instagram, YouTube, just basically all those channels. Send me a DM if you have anything. But the most up-to-date stuff on dividends is going to be at wefunder.com/dividends, or you can go to dividendscapital.com, and I'm sure you guys will link everything down
Yeah.
below.
So we'll put all those links in the show notes for anyone that wants to connect with you. And Swig, always a pleasure, man. We'll have to get you back on once you acquire your first 10 businesses from us using the new fund you've raised.
Sounds like a challenge, man. I'm excited for it.
Awesome, man. Thanks for coming on.
Thanks, Greg. Appreciate you, buddy.
There you have it. I hope you enjoyed it. I hope it got you inspired at all the different things that are happening in this industry. And of course, if you just want to buy a highly profitable business, you can always go to empireflippers.com/marketplace, or maybe you want to make an exit of your highly profitable business, and you could go to empireflippers.com/sell your site. I've been your host, Greg. If you enjoyed this episode, make sure you leave a review, give us a like, a follow, share it across social media. Talk to you all soon. See you on the next episode.